The most important requirement is to deepen and open financial markets in China, giving investors more choices and the ability to move in and out of assets in liquid markets. And that ability would have to apply to both domestic and international investors. Now, that requires an emphasis on the rule of law and reduced exposure to state-mandated restrictions. An investor needs to be confident to hold an RMB security. The investor needs to be confident that the contracts will be fulfilled. It implies more complete and open capital markets. And these more complete and open capital markets will compete business away from state-owned banks, forcing those state-owned banks to be reformed, to be put on a more business-like footing. And the deepening of the financial markets are a necessary but not sufficient condition for increasing dependence on domestic demand as China shifts from export-led growth. Households and businesses in China need to be able to shift consumption and investment across time by being able to save and borrow at market-related rates if they're going to have the means and incentives to increase their current expenditures, domestic demand. And with open financial markets and capital flows, you can't fix both the exchange rate and maintain independent monetary policy. China is a large country with its own growth and development trajectory, will require its own monetary policy to achieve output and inflation objectives. U.S. monetary policy is not and will not be appropriate for Chinese objectives. And the Chinese cannot expect the United States to run its monetary policy to achieve Chinese aims, despite all those complaints after QE2. It's just not going to happen. Therefore, the Chinese will need to allow the exchange rate to fluctuate, and they'll need to grant independence to the People's Bank of China to run an independent monetary policy aimed at macroeconomic stability. Fluctuating exchange rate means smaller current account surplus in China, smaller current account deficit in the United States. It's better that the real appreciation of the RMB occur through movements in the exchange rate than it occur through higher wage and price inflation, which is what's happening now. Seems to me allowing the exchange rate to move is a more stable, sustainable situation than having domestic price and wage increases appreciate the exchange rate. It will produce better balanced growth and hopefully more sustainable growth, better allocation of capital globally and resources, reduce the uphill flow of capital, more net investment in China where returns should be high, less net investment in the U.S. where returns are relatively low. Alternatives to the dollar give more choices to reserve holders, should be faster discipline on the U.S., potentially a less brittle, more stable global financial system.